We're pleased to have with us today Stephen Aniston, better known as Stevie Vicks. Now, Steve is somebody that I've kind of admired and watched on Twitter because he's not one to shy away from giving a good opinion. I laugh in terms of when I see things. I see, like, I'm going to quote a couple here. He says, "Nobody gave the Fed a mandate to generate inflation, period, full stop. The Fed is out of control and needs to be given more detailed instructions from Congress." And when I saw someone with such a kind of market huddle extreme view, I thought to myself, we got to get that guy on. So it's a pleasure to have you on, Steve.
Oh, thank you guys for having me. I'm a big fan of the podcast and the Macro Tourist blog as well.
Well, thank you very much. So for those who don't know, Stevie Vicks is actually specializes in VIX futures. And you can, if you want to learn more about his product that he offers, it's VIXContango.com. So VIXCONTANGO.com. And you originally got your start. You worked at Goldman Sachs and Royal Bank of Scotland, and you were telling us you were a data engineer and or data scientist, I'm sorry, and that you kind of specialize in trading VIX futures or VIX or options or volatility in general. So what do you got on your mind? What do you want to talk about today?
Yeah, so even though my website kind of specializes about volatility and trading the VIX ETFs in particular, giving people kind of trading analytics for it, I also do a lot of fundamental analysis at Goldman and at RBS. I was kind of at places where I did a lot of valuation work and I created a lot of algorithms to do valuations. So what I discuss is basically what drives volatility. What are the fundamental drivers of volatility? And so today I would like to talk about basically what my fundamental view of the market is and where I think things are going in terms of volatility.
Okay.
And what's driving us there.
Right. And I see you might be more in my camp than Patrick's camp, because I see the first slide here. You say the 2019 market outlook, the battle to contain inflation. So I take it that you think this recent scare that everybody's worried about deflation and and rushing out to buy bonds, you view that as it might be unwarranted?
Yeah. So I want to start out with basically the biggest unreported story that is happening right now. And if we can go to the next slide, is basically all of the once Trump got elected. He kind of ruined the whole agenda of the Democrats. I mean, they were planning on to raise the wages, the federal minimum wage, which hadn't been raised for 10 years, which is the longest period that hasn't happened. And so when he came to power and, the Republicans took power, that obviously wasn't a choice anymore. So what happened is all of the blue states, all the Democratic states, they started passing their own versions of wage hikes. So they basically took the Bernie Sanders plan and they started passing these plans, in California, in New York, in Massachusetts, in Connecticut, where I live. So in this chart, I basically put together all the plan, all the states' wage hike plans. And while politically Trump tries to take credit for all the wage gains that we see at the bottom end, this is kind of one story that has been reported, is that the wage gains have been going up, especially at the bottom end. They attribute it incorrectly to the tax cut. The real reason for that happening is this Democratic legislative win, so to speak, at the state level. So if you look at this, about 170, states covering 170 million people in the U.S., right, have implemented these minimum wage hike plans, and they literally raised the wages about like $1 per year, right? So, in California, it's $11 this year. It went up to $12. Next year, it's going to go to 13, and so forth. So if you average it out, right, you have about the minimum wages goes up about 4% in 2018, 5% in 2019. Actually, the biggest crush of wage increases happens in 2020, where it's going to be 8%, right? And then in 21, 5%. So you have this massive increase in wages at the bottom end, which is about 30% of the employees in the U.S., are basically minimum wage workers. So that's basically pushing wages high. That's why we see these 3.5% readings in the wages, and that is going to continue to increase into next year as well.
I think that's amazing. I didn't realize that 2020 that's where the bulk of the gains are going to come. Like I'm looking at your chart here, and 8.4% in 2020. That's a big increase. Like that's even Patrick.
Yeah.
Even Patrick's going to have to admit that there's some inflation there.
Yeah, I mean it's very big. You've seen already how this 5% number is equivalent to roughly 3% for the average hourly earnings on the jobs report, right? For the total number, and so I mean, basically when you take the when the minimum wage goes up, then all the wages after that go up as well, right? So it tends to spread upwards into the workforce.
Right.
You
It's
know,
like
and
it's pushing from the bottom, right?
They did it. Yeah, politically they aimed for the biggest increase to happen in 2020 because that's when the election is, right? They want to go there to win the election.
Oh yeah, that's right.
That's interesting. And the best way to fight this minimum wage increase is to raise interest rates, right? I'm joking.
You would think.
No, but I mean, anyway. Go on with your presentation.
Yeah, so to me that's kind of a big story. It's an underreported story, and the reason why it's underreported is because it's happening at the state level, not at the national level, and the U.S. media generally tends to focus on national level topics. So let's go to the next slide. So this basically these massive wage increases, which we haven't seen for the prior 10 years, right? This is kind of a unique event happening right now, right? I think it's going to work to compress the operating margins of the S&P 500. I mean, we've seen, as you see on the chart, just a massive increase over the years, and particularly in the last 2 years, there's been a big jump, and that is directly related to the tax cut that Trump. But what I think is going to happen not only next year, but I think going forward over the next 10 years, you're going to see, I think, a dramatic change. You know, so far businesses have always won against labor, right? In the U.S. government, you know, we've gotten tax cuts, wages haven't gone up, right? So operating margins have increased over this time. I think what we're going to see going forward is that, wages are going to go up. Taxes are going to go up. Tariffs are also taxes. Tariffs are going to go up. So I think margins are going to come under significant pressure. And it's not going to be just a one-year event. I think it's going to happen over multiple years. I think, this will probably shock you. I think basically Trump is going to be the last Republican president, probably for the next 10 years. And, we're going to see, we're going to be a big landslide victory by the Democrats.
Really?
In 2020, and the whole thing is just going to turn out very big. So the real big battle right now politically is basically, is Biden going to win, or is the left wing going to win with somebody like Bernie or Bill de Blasio or Elizabeth Warren or Kamala Harris, right? So really the battle right now for the governance of the U.S. after 2020 is really happening in a Democratic Party.
I find it fascinating that you make that point, because from a lot of the different reports that I've seen, there's a lot of people that are putting some reasonable probabilities that Trump is going to get reelected. I mean, you don't think this is going to happen at all, right? Like you legitimately believe the Democrats are going to sweep here?
So let me just give you some background into. I do a lot of political predictions because I'm good with stats and data as part of my work, and so I did predictions for the 2016 elections and for the 2018. So in 2016, I went into the election saying that Trump is going to win and there's going to be a win by the GOP. At which point half of my subscribers walked out, right? But I basically said the best case scenario is for Hillary to lose, with be a split vote, and then the Congress, the House, which is held by Republicans, will make Trump win. Then in the 2018 election, everybody thought the GOP is going to hold the House, and I kind of called the Democrats will win the House. I even called the seats, like 240 seats or 235. I almost called them to the seat, and I also said that Republicans will win the Senate, right? Which is a very unconventional view, because most people thought either there's going to be a Republican win across the board or a Democratic wave across the board, right? So I also called that pretty well. Now, why am I telling you that that Trump is going to lose basically by a landslide? The key state here to focus on is Texas. Trump won Texas by 800,000 votes. Beto O'Rourke, or Ted Cruz, which is a Tea Party candidate and the closest thing to Trump, in the Republican Party, won by only 200,000 votes 2 years later in 2018. So there was a 600,000 vote difference from Trump to Ted Cruz. So what's happening is you have a huge migration from California to Texas going, because housing prices are very high in California, which is now accelerated by the SALT cap. So you have about 100,000 people moving from California to Texas. And you have to understand that basically a moderate Republican, right, in California is really a left-wing Democrat in Texas, right? So it's basically a Republican in California has the same belief system as a Democrat in Texas. They're fiscally conservative and they're socially liberal, right? So that is skewing Texas. Basically, Biden just came out. There was a poll that came out, Biden leading Trump by 4 points, and every other person was within 4 points of Trump. I mean, that is unheard of. And basically the numbers are within 100,000. They're very, very close. You have 2 more years of migration and Texas is turning blue. So it is going. That's not only happening in Texas. I think the South Cap, you saw how it turned. All the Republican counties voted for Democrats. The South Cap was a very big mistake by the Republicans, and basically. There's not enough votes for Trump. I mean, he barely won in 2018.
I mean, he called Cruz. What was his nickname for Cruz? Like Lion Ted, or something like this. Like
Lion Ted, yeah.
I mean, at least for me, like I think Trump, looking at Cruz's numbers, it may not be reflective. Maybe, yeah. I mean, you might know better.
Okay,
yeah.
1 second, Patrick. I'm going to jump in here because the last thing we need to do is get into a discussion about politics, because it's one of those can't wins, and you should have known that. So, Stevie, I have a question for you. If you are correct about the probability of the Democrats winning, and needless to say, I think you think that that's a much higher probability than the market believes. Do you think that will be or what do you think will happen to the stock market? I don't want to put words into your mouth before I'm
going to continue here with the story. So basically, if you have a stronger presence of the Democrats in Washington, and this is going to be a more liberal, this is no longer your Clintonian Democratic Party, which is pro-business. This is a more pro-labor party now, right? So you're going to see tariffs increase. Maybe tariffs made a border-adjusted tax, right, is going to come back in some form. But you're going to see corporate taxes increase, right? And actually, I want to talk about this because this is an imminent thing. Nobody's really following that story. But basically, Trump and Pelosi have had this conversation about infrastructure. And when you look at the actual negotiations, basically what the Democrats want is they want to bring back the corporate tax level to 25%. They want to raise the corporate tax. They want to reach back to the pre-tax cut levels to 39%, and they want to bring back the alternative minimum tax, right? So basically, they want to raise. They want Trump to raise taxes. Now why is that happening? Is because the budget deficits have really exploded way beyond the projections, right? The revenue is coming to the Treasury is not enough, and so
it's Stevie, it's actually ironic that the Democrats are being the ones that are worried about budget deficits, but it's always the party not in power that's worried about the deficits, isn't it?
Well, the Democrats have actually a good track record on budget deficits. I mean, Clinton had surpluses. Obama went from deficits to basically closing them up, and then Trump is blowing them up again. So they have the Democrats, they like to tax. I mean, there's no doubt about it. They like to raise taxes. Obama put an investment tax. That was a big reason why the deficits declined. So that's not unusual. But what I'm trying to say is, like, basically the Treasury right now is running extraordinary measures. There's a debt ceiling coming up. They're going to run out of money basically in the August-September timeframe, and so they have to pass a deal to Pelosi. And so if Trump, right, as you see, Trump always backs down, but guess who's going to back down to this time? Before he had to back down to Paul Ryan and all these guys, and they wanted more tax cuts. Now he has to back down to Pelosi, which she wants corporate tax hikes, right? So what people don't realize is that this tax code is not going to stand. And that's the primary source for my bearishness. This tax code was voted on by 50 Republicans through reconciliation procedure. It has failed basically the Byrd rule, how much it increases the deficit, right? And so they're going to come back with a tax hike. This happened under Reagan as well. He passed a tax cut, and a few years later had to roll it back. So I think this is kind of what's happening, and what's going to drive the earnings growth in the stock market to come to an end.
Right.
Okay, now if this happens, when does the market start to figure this out? At what point do they start to discount your worry about the tax cut getting rolled back? Do you see this as this fall, or is this like a story for this year or next year?
No, it's absolutely a story for the summer. So if you go back to the previous slide, so I just want to show you, why the market has done so well is because we had this big growth in earnings over the past 3 years, right? 16%, 20%. You had oil going up. You had the big tax cut, right, driving earnings. So that drove the market higher. It was very bullish in 16 and in 17. Then in 2018, I got bearish because I looked at the tax reform and I said, you know what? This is going to explode the deficit, right? And this tax code is not going to stand. So then the Republicans are going to want to take it, they're going to want to, rewrite this tax code, right? So the earnings going forward are going to get affected. If you raise the corporate tax rate, right, to 25%, and you raise the investment taxes, you will see, earnings are going to decline, and you're going to hit, the market is going to get a hit, because people won't have money to invest in. So let's go to the next slide. So this year, when talking about earnings, it's very similar to 2015. What's happening is earnings have fallen off the map. You see the 2000, the first quarter earnings quarter over quarter were up only like 2%, right? And then, they have 10% projected. That's going to come down. But what has happened is the analysts have put all the earnings in the fourth quarter, right? So they're basically projecting we have this miraculous earnings growth that's going to happen in the fourth quarter, which statistically is like basically unparalleled, right? If in the chart below, crazy. You see how it's 44% growth. 44%. I mean, we didn't have it in the last couple of years. We have tax cuts. You only have this type of growth when you come out of a recession, right? We're nowhere near. We're not in a situation like this. So this happened in 2015. They tend to pack the earnings, and then they start to lower them right before the third and fourth quarter come. And if you remember in 2015, what happened is the market kind of held up through the summer, and then in August we had a huge collapse. And everybody tries to attribute the collapse to China, which is one of the causes. But the bigger cause was that analysts had to severely downgrade their earnings, and we're going to have the same thing happen this summer because this 44% growth is just not going to happen.
I like where you're going with this. This ruins Kevin's narrative, but anyway.
For sure it does. And that, you know what? I love hearing the other side of the argument. So how low do you think we go, and how bad does it get, Stevie?
So I'm I'll kind of discuss this. I have a different view of how people analyze. So, for example, I don't think tariffs are bad for the U.S. economy. I think they're bad for the Chinese economy. They're bad for the Mexican economy because basically they have to lower prices, right? And they have to compete. But that is good for the U.S. economy. I view any factory that goes from China or Mexico to the United States, I view that as a good thing for the U.S. economy, right? So I don't view tariffs as a bad thing. I also don't view tax hikes in the current place is a bad thing either. I thought tax hikes give income to savers, which then they spend. So I'll discuss this a little bit more later, but basically, I don't think we're in like this. A lot of people see this giant recession coming in the future. I see slower growth, but I don't see a giant recession. What I see is a market that is very overvalued, right? I see earnings that are very high, right? So what I see, once we slow down and once taxes get raised and once tariffs get put on and once wages go up, earnings basically decline in a big way, right? They're leveraged to these effects. So earnings can drop dramatically, right? The only reason why earnings growth is so strong is because everything the government does has been to help the market. Now imagine you have a government that does not help the market, right? Then earnings are going to collapse. And even if you have a mild recession or if you just have more aggressive regulatory stance by the U.S. government, earnings can go down in half, right? That's why I have this blue line. So they can go from 150, 160 to about 80, right? So let's go to the next slide. So if you look at, so not only do we have kind of prospects of earnings going down because of government, change, the government philosophy of the United States changing, but we also have a market where earnings are have very high multiples. So here I have presented to you the trailing multiple on the top and the forward multiple at the bottom, right? So on a trailing basis, we're at about 20, right? So we kind of peaked out at around 25 in January of 2018. That's why I kind of say that the bull market ended there, because that's when investors were willing to pay the most for a share of earnings, right? And since then, that has been declining. And the story is very similar on forward earnings. Now, there is kind of arguments between forward and trailing earnings. Basically, both are important for the market. Like if you say I can make $100, but then if you don't deliver anything, right? I think people are going to sell your stock, right? So people look at trailing earnings as validation that the projections are valid, right? So both things matter, and on both measures, we're at basically at the high end of the range, historical range, right? We're like 95 percentile. So if you look at the forward earnings map, I have it in yellow, right? You saw how through much of the recovery, the market traded at much lower multiples, right? 12, 13, that's where usually markets are. 15, this stuff where you see 16 and 17, this is very high valuations, and then even got as high as 19. I mean, that's kind of ridiculous. So, you get, the way you got to think of it is the valuation is a function of earnings, right? Like if you have higher earnings growth, if earnings grow 20%, you can put a higher valuation, right? So that made sense the past 2 years because earnings growth was 20%. But if earnings growth goes negative, or goes to zero or goes to 5%, all of a sudden the multiple has to collapse. So this is why markets are so volatile. You not only do you have collapse in the earnings, but you also have collapse in the multiple. So there's a double whammy that comes in.
Fair enough. Steve, we're going to have to, we're going to save it for the after hours. This is terrific stuff. Everyone, before we go, we're going to sign off for Stevie at this point. But before we do that, I just want everyone to know where they can find more of your stuff. First of all, tell us about your website, where they can follow you on Twitter. And I must say you're a fun Twitter follow because the reality is that you do not mince words. You make me laugh all the time with your kind of your tweets, and I think everyone should kind of follow you. So why don't you give us both your website and your Twitter handle? So
my website is vixcontango.com, and my Twitter handle is @vixcontango. I mean, Twitter, when I first saw Twitter, I thought, I can go and complain about, my innermost thoughts, and everybody can hear it. That's awesome.
Anyways, thank you so much for coming, Stevie. And for those who want to hear more, make sure you stick around to the after hours.